Hey, this is Matt from InvestiQuant. Today is Thursday, September 17th, 2020. Yesterday we had the FOMC announcement come out and the market ended up selling off after the release, after the speech, and into the close. We have followed that action up with more selling in the overnight session, and we're down sizably as we approach the open. The NASDAQ at the time of this recording is down over 2%. The S&P is down about 1.5%, but all of the markets have sold off even more in the overnight session. So what I want to do this morning is take a look at what has happened historically when you get a sizable down gap after the day of the FOMC announcement. So let's set this up. We're going to go into Discover and we're going to select all four instruments. The setup is going to be based upon getting long at the open, which is 9:30 a.m. Eastern Time, and exiting at the close, which is 4:15 p.m. Eastern Time. Now for the opening location, as I think this is important today, is we're going to be using a gap size as the percent of the 5-day ATR. And what I'm going to do is I'm going to take half of the 5-day ATR and make that a minimum gap size. So that means you're getting a gap of at least 50% of the 5-day ATR on the downside. So I'm adding gap down of at least 50% of the 5-day ATR. Just for reference, the 5-day ATR in the S&P right now is 61.5 points. So we are, at the time of this recording, well over that amount as we approach the open. Next, I'm going to go into market events, and I'm going to say that today is the day after the FOMC announcement. And lastly, I'm just going to add that it's above a 200-day moving average. I really can't add much else to this because we'll lose too many samples since this is a rare scenario. So let me hit view results and we'll take a look at it. And here we go. So these are the results of going long at the open, 9:30 a.m. Eastern Time, exiting at the close, 4:15 p.m. Eastern Time, on the day after the FOMC announcement, if there is a sizable gap down at the open and above a 200-day moving average. Now, historically, this pattern has only happened 17 times dating back to 2003 in the S&P. The NASDAQ only has 9 samples, Dow 17, Russell 11. So this is very rare. We're not seeing a whole lot of samples here. Looking at the win rates, you can see they're all a little bit weak. But keep in mind, these are small sample sizes. So small sample sizes do not take much for these win rates to move. You know, only 1 or 2 wins would push these win rates right back up. So I would not read a whole lot into the win rates saying that it has been weak. What I'm more interested in doing today is looking at the results distribution. So let's take a look at it here in the S&P. And on the results distribution, the way it's set up, trade counts are on the vertical axis. The P&L in dollars based upon trading one contract is on the horizontal axis. We've got the zero line right here in the middle. And the taller these bars are, the more frequently they have happened. The more extreme sides, so the very far left or the very far right, the bigger the moves have been. And looking at this results distribution, you can see there has been a lot of big losing days, and there's been quite a few big winning days. There has not been much here in the middle. We've got single samples here kind of mixed throughout, but the largest sample sizes have happened on the extremes. So in both directions, the extreme downside, more than 20 points lower, has the most. The extreme upside, more than 20 points higher, has the second most. So what I'm reading out of this is, you know, the win rate is not as important to me today because there's not a whole lot of samples, but there is potential for some really large moves on this type of pattern. So hopefully you found that helpful. Good luck today, and we'll see you next time.